Welcome to Market Call. I'm Marella Fernandez. Dennis De Silva on the show today. He's Senior Portfolio Manager at Middlefield Limited, and he's taking your questions on resource stocks today. Here's how to reach us. Call us toll-free, 1-855-326-6266. You can also email your questions, marketcall@bnnbloomberg.ca. Dennis, thanks for coming in. Commodity prices have been on the move with the on and off tariffs. Nobody really sure what's going on. What's your outlook for gold given the current climate?
Obviously, gold is a key beneficiary of uncertainty and chaos, if you want to call it. So gold has certainly done well. I think since the election in November, it's up about 20%, and year to date even more. I think it will continue to benefit from this uncertainty and, these wild swings. Even though the market has recovered from April, I think at the end of the day, the fact is nobody's quite sure from maybe a sector-to-sector basis what President Trump's going to do in terms of tariffs. We've seen it obviously with aluminum and steel. I think we're still quite a ways from understanding the overall goal and where things will ultimately settle. And again, that's beneficial for gold, I think, in the short term and even midterm. But at the end of the day, the long-term perspective we have on gold is that we see continued central bank buying. I think central banks have realized the need to diversify away from the U.S. dollar. I think that started probably with the Russian invasion of Ukraine and the fact that their assets were frozen. And I think that woke up the world to, not everything is as stable or secure as you think. And the fact that people are worried about U.S. debt, running GDP deficits and so forth, all those types of things, I think, drive people to think or reevaluate how they want to own the U.S. dollar and perhaps diversify into something like gold. Because
we saw a lot of people sort of flee out of markets and into gold in that April drop in the markets, I'm wondering whether you think we'll see that same pattern but in smaller numbers, just because people are now getting used to the fact that things are announced and then pulled back.
Yeah, I think there's a level of complacency now where people have seen him come out with these dramatic numbers and then kind of pull back in a reaction to how the market perceives it. And I think something like gold, again, I kind of look at it like an underwater current. There is this steady current of central bank buying, and then above the surface, you sort of have investor demand, which could come and go on a monthly or weekly basis. So I think steadily we'll see an improvement in gold with significant gyrations, because I think for the last 2 months, you've seen 2 or 3% swings in gold, which is kind of uncharacteristic. And I think that is an underlying symptom of the fact that you get these significant ETF inflows and outflows that will drive it on sort of a day-to-day basis. But we kind of want to keep our eye on the prize in terms of what do we think fundamentally is happening, and will that change over the next 6 to 12 or 18 months? And we don't think that underlying story is changing.
A lot of pressure on oil as well. OPEC now saying another 411,000 barrels coming online in July after May and June for the same. Donald Trump wants to keep the price of oil low so people can have cheaper gas, etc. What's your take on the forward movement for oil? We're still up about 62.54 today, so above 60. But do you think it's a possibility of dropping back down?
I think it's shown fairly good resistance around 60, whether it's a buck below or a buck above. The market is grappling with, obviously, the demand side, whether this uncertainty and these significant changes in global trade will mean economic slowdown and what that has implications for oil demand. And then on the supply side, I think what keeps it in a fairly equilibrium state around $60 is the supply side, I think, comes off. Even though OPEC is introducing some of its cuts over the last couple of years, I think you'll see U.S. shale production probably decline over the next couple of years as they don't redeploy as much capital as they did before, because $60 kind of gets a little skinnier in terms of their profits. They probably have a break even in that $45 to $50 US a barrel range. So I think things will settle in and around 60 until the market gets a little more comfortable about what are the real ramifications of this trade turmoil on economic growth globally.
Got it. All right, we are going to take a quick break, lining up some phone calls and some emails for Dennis De Silva, Middlefield Limited, taking your questions today on resource stocks. Back in a moment. Welcome back. Let's go straight to an email from Gus. He says, hi, can I please have the guest's opinion on Teck Resources. Dennis, what is your take on Teck?
You know, I don't currently own Teck. I've been in and out of it, depending on how I feel about copper and obviously what's going on with the tariff war with China. You know, when they sold off their coal business, they kind of became the critical minerals champion of Canada, really the copper champion. I think they're the 11th largest producer globally of copper. And a lot of that is pinned on this big QB2 mine, which, you know, probably is a year behind. They continue to struggle to get it up to full speed. But I think it's important because it will double copper production for Teck, I think, by 2027. So material growth in such a large name, it trades at a discount if you look at it on a pure basis for premium copper producers globally. I think for me, I'll get back into the stock very soon. I like where copper is. It's just under $4.90 US a pound. And funny enough, that's against the backdrop of uncertainty around China, because clearly copper is very sensitive to what happens in China and processing and so forth. So I think this is a good point to probably start looking at Teck again. There's probably some more buybacks coming once QB2 is a little more steady, and that's going to be good from an organic perspective of return of capital to shareholders, as well as the organic growth from QB2 reaching full potential over the next year or two.
What kind of problems have they been having trying to reach capacity?
Yeah, you know, it's not unusual things. You're talking about a massive multi-billion-dollar mine, and you name it in terms of issues, whether it's equipment or sometimes weather, it's been an impediment, and people have kind of been waiting for that steady state. Q1 was a bit of a disappointment, but now people look at it every month to kind of see if they are reaching their throughput, at least what was being projected. And they're getting there. I think probably Q3 is when we'll start to see some really good momentum start to build in the stock.
Got it. Okay, let's go to the phone lines. John from London today. Hi, John.
Hi, Marilla. Hello, Dennis. Constellation Energy offers a suite of energy products from hydroelectric, nuclear, wind power, solar power. Just signed a deal with Meta to provide nuclear power for data centers. Constellation Energy, I bought it fairly low, did well last year, and it pulled back, but now it's coming back courtesy the talk from Washington. What do you think for a 2 to 3 year hold? Thanks very much.
Thanks, John. I will admit it's a name I don't currently own. I like the relationship to the uranium stocks that we own, but I think at the end of the day, it's going to come down to trying to secure deals like the Meta deal or like we saw with Microsoft, because you're going to need that kind of capital to give you the comfort level of trying to build out new capacity. I mean, we've seen it with more traditional nuclear in terms of the cost overrun. So I think the Meta deal, the Microsoft deal, the Amazon deals that you've seen with various players will be an important support mechanism in terms of their capital being able to support the decision process for these guys to expand production. Now, in this case, we're not talking about new builds for the Meta deal, but I think going forward, you're going to have to see significant new capacity come on, and you're going to have to see a partnership with the companies who need it, these data centers in particular, because they have the capital and access to capital and cost of capital that they could marry with these energy companies or providers in order to reduce the inherent risk of bringing on new projects.
So do you think we'll see more of these kinds of partnership moving forward?
I have no doubt we will. You might even see things translate all the way downstream in terms of probably securing uranium deals. So you'll see them securing energy deals and then trying to also provide the capital to make sure the uranium supply is locked in for new reactors. Probably more modular reactors, which is where the new technology is coming from. But we saw that with critical minerals, where you'd see the car companies invest in lithium projects or in nickel projects, because they wanted to make sure they had access to the materials that are important feeders into the project.
And we know critical minerals from China are being sort of, there's a bit of a stranglehold there, and that's feeding into the automotive market as well. Okay, we hope that helps you out. Let's move on to Michael from Vancouver with his question. Hi, Michael.
Hello, Marilla. Hello, Dennis. Folks, thanks for taking my call. Dennis, I did hear your thoughts on the gold commodity being still strong, in your opinion, 12 to 18 months from now. Agnico is more than doubled over the last 24 months. Some have considered it best in class. I just wonder what your comments are on Agnico. Is it a little bit too late in the day to purchase it, or are you still buying it for clients? I'll hang up and listen to your response. Thank you. Have a great day.
Thanks Michael. Yeah, you're right in saying it's best in class. You know, when I think of Canadian investors, they always think of Agnico Eagle in terms of the safe way to play gold from an exploration and production perspective. And then you think of Newmont from a U.S. institutional perspective. That's kind of their go-to name. It clearly is up there on the valuation scale. It trades at a premium to its peer group. I would say it's well-deserved, although they took it on the chin, I think, after Q1. Being a miss, but that's what happens when you are such a premium stock. You know, I had a chance to sit down over a lunch presentation with management, and you just, you know, I attended the Mining Hall of Fame luncheon or dinner in February, and Sean Boyd was inducted. And to hear senior management speak, you could just get such a good perspective on the culture and why they are successful and have been successful for so long. You talk to partners, companies that they've invested in or that they have partnerships with, joint ventures, and you never hear anything bad. It's always
explain a little bit more about that. It's nice to hear that that exists, but explain a little bit more about what people were saying about the company.
Yeah, I think we see many companies who make investments in smaller tier companies as a way to probably get a perspective on a new emerging play, and then maybe they will buy them down the road. Agnico likes to foster a lot of these types of relationships, whether it's in North America or in Mexico and other countries. And it's not just giving them money. They actually work in partnership with them. They form technical committees. They're actually involved, because one of my favorite questions when I hear these types of deals, I say, well, how involved are they with you? What kind of advice do they give you? Because it's great to get a check from them, but are you getting real insights? Are they looking at the data from your drilling and giving you some perspective on maybe this is what you should do with the next round of drilling, or you should target this or that? They are very involved. They don't just write checks. They are technically involved, and they don't force themselves on you, but I think every company who takes a check from them wants their feedback and their technical expertise.
So they're willing partners who want to make it work.
They do, and it doesn't, trust me, I think the track record is 98% of the time the companies they invest in, they don't actually acquire them. You know, the most recent one was O3 Mining, which was right next door to an existing project that they have. So it's far and few between, but I think it's just a key insight into how they think. They want to be in emerging areas. They want to see what you're doing. They want to provide insight into it. And ultimately, if the stars align, they will purchase you because they like what you're doing and they want to establish something new.
Got it. All right, we are going to take a quick break. Dennis Silva with us today from Middlefield Limited. He's taking your questions on resource stocks. Here's how to reach us. We're back in a moment. Welcome back to Market Call. Let's go to the phone lines. David's on the line with a question for Dennis today. Hi, David.
Hi, good afternoon. Thank you for taking my call. My question is on CNQ. And I noticed that about 14 months ago in April of 2024, it hit an all-time high of about $55, and it's been sliding down to $42 today. Is there a reason for this weakness in this particular stock, especially given it's one of the best Canadian oil stocks? I would like to know that do you own the stock, and if not, would you recommend a stock in this space? Thank you very much, and have a great day.
Is this affected by the price of crude, or what's going on for CNQ?
Yeah, look, without a doubt, it's related to the price of crude. You're not going to find a single oil stock that will defy gravity in terms of oil going down and the stock not going down. It also is a little more susceptible to the noise around tariffs, in particular on oil or energy in particular, because they're not as integrated, say, as Suncor or Imperial or even Cenovus. So they are at a little more risk, but I think that's dissipated largely. Funny, in the last segment, we talked about Agnico Eagle. I kind of put CNQ in the same thing, kind of best in class. You know, I know Suncor's done a great job over the last 2 years to recover and build culture, but CNQ has always been there in terms of most consistent, in terms of per share growth, profitability, free cash flow, returning capital to shareholders, and I think they're second to none from that perspective. But that's been some of the near-term noise. Nice yield, 5.5%, I think, is the current dividend yield. I think in general, the energy space in Canada, especially let's call it the seniors, are looking at high single-digit rates of return between a nice dividend and organic growth, or buybacks that reduce per share count and therefore will enhance the per share returns. And then when you start to look more at the intermediates or larger independents, you're looking at low double-digit returns. Again, between dividends and buybacks, which are quite healthy, I think probably the free cash flow yield for these companies are in that probably 9 to 12% range. And then organic growth, low single digits at this kind of pricing range for oil or gas. That's a very tidy return, especially when most of it is dominated by dividends in particular.
Got it. Okay, David, I hope that helps you out. Let's go to Wayne on the line today from Edmonton with his question. Hi, Wayne.
Hi. Thanks for taking my call. I have a question on oil stocks. I have Suncor, and I'm a long-suffering holder of Baytex, and that's going nowhere. Anyhow, things are going down a little bit because of the how much oil is in the world and OPEC, et cetera. But I'm wondering if now would be a good time to buy some oil stocks when they're down a little bit, and what would be your favorite Canadian ones to purchase? Thanks. I'll listen to your response.
Thanks for the question, Wayne.
Well, it's almost a 2-for-1 question. We were just talking about CNQ.
I was going to say, you might have answered that question.
I would say it's probably
already.
my favorite, but let's dive into the weeds here in terms of, at least with CNQ, it's about 27% gas, so we'll say it's not pure oil. If you want to get into more pure oil, you mentioned, Wayne, Suncor, again, a company that's made tremendous strides over the last couple of years. And when you talk about timing, it's interesting, Bank of Montreal put out a report today showing insider buying over the last 90 days has been the highest by their records in the last 5 years. I think about $54 million of insider buying. And I think that's a testament, at least it gives you some insight into what the people at the top think about the value in their companies. I talked about those high single digits, low double digits sort of total returns between growth on a per share basis and dividends and buybacks. And I think the insider buying speaks volumes. And it ranges from gas companies like Tourmaline or Peyto to oily companies like a Tamarack and so forth. So I think the timing is quite good. Oil has shown resistance at $60. Whether it's $1 below or $1 above doesn't change a lot. There's some pretty good hedging programs in place. And fundamentally, these companies are, in some cases, you could argue they're under-leveraged in terms of they're very healthy, usually under 1 times debt to EBITDA. So I think the timing is pretty good, especially if you want to look beyond 2025 and say, okay, look, whatever is going to happen with tariffs, somehow it gets resolved over the next quarter or two, and we're going to have, whether it's a 10% flat tariff across the board or not, or it's sector by sector, I think something like energy will bypass that because of how strategic it is. I don't think you're going to see a 50% tariff on Canadian oil or natural gas. So I think something like Suncor, CNQ, even Cenovus, which is showing good downstream turnarounds, those are kind of names you could sleep with at night, not worrying about what the implications are beyond the next few months.
Got it. Okay, let's go to the next question then. Eddie's on the line from King City. Hi, Eddie.
Hi. Thank you very much for taking my call. It's wonderful. Always a great show. I really enjoy it. Really enjoy your guest. Dennis, my question is going to be on Ivanhoe Mines. Earlier this year, I've been buying it, selling it, trading it between 12 and mid-14s. I did sell out in the mid-14s, and I have bought back at 1060. Now, I know what's happened with their Congo mine, with the seismic tremors. They've had flooding in the mine, and the mine has been shut down. Now, there are good investments and bad risk investments. What do you think of Ivanhoe Mines as an investment, good or bad investment at this price at 1060?
How do you feel? Thanks for the question, Eddie. How do you feel about some of the mine operations that are in places in the world where the geopolitical circumstance or interior political circumstance is, not so steady, not so concrete?
Yeah, it's a good question, and thanks, Eddie, for the question. Clearly, I'll tell you, I don't own Ivanhoe. I know it's been founded, and the chairman is the legendary Robert Friedland. So I take nothing from Mr. Friedland, but he's shown this ability, as do the Lundin family, in operating in difficult environments, geopolitical risk, you name it. So we've avoided that. You know, to me, a high or a risky area I would invest in, I would argue, would be places like South America, Peru, or Chile, because, you know, social license is something you can't take for granted. It's very easy to think, oh, you know, they have long established mining regimes, but we've seen it with Panama, with what First Quantum's dealing with. There's no such thing as an easy path when you're talking about, you know, more emerging areas. We're not going to call, but, you know, developing nations. And I think the DRC, look, it's just a non-starter for us. It's unfortunate they've had this seismic event because the mine was finally kind of finding its stride. They had the power deal. You know, production was going to double from 2023 to 2026. And I think it's the fourth largest copper mine in the world. So significant potential. I just wish it was in another jurisdiction.
Got it. Okay. We're going to take a quick break. When we come back, we'll have a look at Dennis's past picks. Back in a moment. Welcome back. Time now to take a look at Dennis's past picks, which are from March 4th of 2024. At the time, he picked Headwater Exploration, which was at $6.95. Now it's at $6.49, so a 7% drop return and under a 1% upside return. They do oil and natural gas. Again, is this just the price of oil that's hitting this company? I guess it's a hard time to come in and do past picks when a year ago things were quite different.
Yeah, I mean, Headwater is a heavy oil producer, conventional heavy oil producer. They're in one of the, you know, the most popular plays in Canada, the Clearwater play. Nothing the company has done wrong that would suggest it's down 7%. It really just comes down to their leverage to oil. As I said, you're going to be hard-pressed to find a stock chart that is up while oil is down if it's an oil producer, regardless of whether it's light oil or heavy oil. So we continue to own Headwater. We still believe they're making great strides in this. I think the yield is around 7%. So you have a nice mix again. And I'm going to hark on this because I think this is important from a total return perspective. Nice low single-digit per share growth. And the nice yield of 7%, which is fully defendable, probably down to $53 a barrel. And you're going to get a nice high single digit, let's risk it, I'll say even low double digit rate of return without oil going to $70.
Okay, so you are holding on to it until things bounce back a little bit at least.
Yeah, because the operations are being run very well. They have excellent balance sheet, more than enough runway to grow. It's just about managing that growth in an environment of, say, $63 oil. They could ramp that up quite easily if oil goes up. If it drops, they'll continue to probably slow things down a little, maintain things at low single-digit rates of growth with that nice supportable dividend. So again, investors could get a nice total return in an environment where maybe the commodity is not doing too well.
Got it. All right, let's move to your next past pick from March of last year, Turmaline Oil. At the time, it was $62.80. It's now at $63.59, so it has moved up, a 1% return and a 9% total return. The 9% total return you can't turn away from. That's decent.
It's great. And again, I think this harks back to my view of total return is important. And even though natural gas is up probably 50% from a year ago, at least AECO is, and NYMEX has even done better in the U.S., I think the fundamentals of their business in particular, I'll call them best in class outside of the senior producers. They're the largest natural gas producer in Canada. They're about 25% liquids, and I think that might increase over the next couple of years. They just know how to do it right. The CEO was one of those in that insider trade. I think he bought $2.4 million worth of stock over the last 90 days. He doesn't get paid a salary. All of his stock is in that company, and he's worth more than $1 billion. And they always focus on costs, kind of expanding in their existing areas by buying other partners in their plays or on the fringes of their plays. They're a fantastic consolidator. They were part of that Strathcona sale of 3 assets. They were one of the buyers of a smaller package. They just acquired a 50% partner in one of their assets. So they just nimble away. They keep doing what they're good at. It's kind of like C&Q. There's not a lot of flash. They don't always press release when they buy stuff, land or companies. They just stick to their knitting and grow on a per share basis. In this case, through special buybacks or dividends, I should say. They also do buybacks and their regular dividend. I think the dividend right now is just over 3%. A good high single-digit total return basis until things get better. And in their case, we are looking at gas prices improving materially into the end of the year with LNG Canada coming on.
Yep.
And there's significant exposure there, and in particular 2026, when we start to see the differential or the basis differential between Canadian gas prices and U.S. gas prices shrink.
Got it. Let's get quickly to your last pick, which is Capstone Copper. At the time, it was $7.21. It's up to $7.74. 7% upside for return and total return. They do silver as well. Is it the copper part of their business you think that is pushing them forward, or both?
It really is copper.
Okay.
I mean, they're going to grow 30% in 2025 from 2024 because of their the continued growth in their core asset. You know, this company did a very transformational acquisition or merger a couple of years ago that really solidified their position in Chile, going from 2 mines to 4 mines. You know, it's a company that's going to double their copper production from 2023 to 2025. Free cash flow becomes an inflection point in 2025, so really start to generate significant free cash flow, especially with copper around $4.90 US a pound. I think the big question becomes a little bit of geopolitical risk because it's in Chile, and also what's the next leg of growth? Fantastic growth for the last couple of years, and then Santo Domingo, another project that's next door to their existing mine in Chile. It's trying to find a partner for this next major project, will be the growth driver for kind of 2030 and beyond. So I like the valuation. We continue to hold it. It's, you know, I think it should be a $10 plus stock, and I think it will go through this re-rate.
Got it. All right, Dennis De Silva with us from Middlefield Limited. We'll go back to taking your questions when we return. Welcome back. Thanks for joining us here on Market Call. We want to go straight to the phones. Martin's on the line today from Waterloo, Ontario. Hi, Martin. What's your question?
Hello, and thank you for taking my call. I'd be interested in the guest's opinion on Labrador Iron Ore Royalty. Given its nature, I wouldn't necessarily be expecting tons of price appreciation, but the dividend looks attractive to me. So I'd be interested in any insights you might have. Thank you very much, and I'll hang up and listen.
Yeah, thanks, Martin. Yeah, Labrador Iron Ore owns an equity. I think it's just over 15% of Iron Ore Company of Canada, as well as a royalty. So that's how they derive their income. The mine is near Labrador City, and it's run by Rio Tinto. So you can't ask for a better operator. They had a difficult Q1. I think Rio Tinto's guided that things will be made up over the next 3 quarters, so they'll stay on track with full year forecast. Yeah, the dividend's attractive. I think it's around 7%. The issue with this mine is always trying to get consistency out of it. It's just hard to get a full year, quarter by quarter of consistency. So it doesn't have that consistent track record. A lot of capital's been spent on the mine to try and upgrade it and update it so that it could be more consistent. So I think that could lead to a re-rate beyond, the attractiveness of the dividend, is if you could see more consistency. You certainly have a world-class operator in Rio Tinto, but you got to get more consistent in terms of getting that mine to be better on a quarter-by-quarter basis and less inconsistent, which is something the market hates.
All right, we hope that helps you out. Let's move on to Anne, who's calling from Scarborough, Ontario. Hi, Anne.
Oh, hi. Dennis, I already own shares in Kamico. Should I buy more at this price for a long-term investment? Thank you.
Thanks for the question. Let's pull up Kamico, which we will do now. What's your forward look on Kamico?
Yeah, that's an easy one, Anne. I would say, look, uranium stocks had a fantastic run, when uranium prices got over $100 a pound, and then they settled back down right now around $65. I think I always have to have this little short lesson between spot market and term market. The spot market is probably what people look at every single day, and that's where you see the gyrations in uranium prices. And right now, I think it's around $65 a pound. The term market is where most of the long-term contracting gets done on. So the utilities are buying for the long term. They're not just trying to buy, hey, for the next month or the next 2 months. So that has been fairly steady. It doesn't come down as much, doesn't go up as much, closer to, say, $80 a pound. So the fact that you could buy Kamico now, I know it's not at a 12-month low, but fundamentally speaking, you have utilities that are not properly covered in terms of their needs. You have supply issues. Places like Kazakhstan, for example, still haven't been able to ramp up to expectation. Not a lot of people are starting new mines because to them, you probably want to see something closer to $100 a pound before people want to spend hundreds of millions of dollars, if not $1 billion plus, on new mines, and it takes time. We had one project in the U.S., but that's a lower footprint kind of project, but under President Trump's executive orders, that was fast-tracked, and it got approved after a few weeks rather than a few years. Will that be a dominant factor? No. And the U.S. is not going to swing the market at the end of the day in terms of their own production. So I think you could buy it now knowing the fundamental trend of energy is required. SMRs, which are modular reactors, will become reality over the next 10 years, and there will be more demand coming into this market. Whether it's the Germanys of the world, the South Koreas of the world, the Japans of the world, reactivating reactors or building new reactors like China, uranium has a very good outlook in terms of supply-demand dynamics over the next several years. And, of course, Kamico is the poster child for uranium.
Got it. And I hope that helps you out. Let's move on to John from Toronto with his question. Hi, John.
Hi, Marella. A big well done to you, Marella.
Oh, thank you.
Yeah, and I have to say your switchboard, great staff there. Dennis, we sure don't see you that often, but it's nice to see you. Dennis, I'm a big believer in HudBay Minerals. I bought it at 6, and it's doing well. I think I'm going to see 15, but I may have a chance at $20. They have a big production in Peru. They're in Manitoba, a copper mine, but their side product is 300,000 ounces of gold a year. And they bought Copper Mountain in British Columbia. It's got a 30-year mine life, and they have a big rich, and I stress that, a rich deposit in Arizona. So am I going to see 20, Dennis? And thanks for helping us out.
Thanks for the question. So let's look at HudBay. So if you bought at 6, you more than doubled, which is great.
I think John almost convinced himself to buy more because he was very good at describing it. Look, at the end of the day, this is a company that's going through significant free cash flow right now. He's right. You've got copper, you've got gold. I think what the market is really waiting for, the re-rate, the next move, in John's opinion, to $20 will be what happens with World Copper, their project in Arizona, massive project. Clearly in a good jurisdiction now that you have President Trump in, and he wants to see more critical minerals like copper producing in the U.S. I think it comes down to, at this point, trying to find probably a partner. It would increase their copper production by 50% based on current projections, but our hope is they could come up with a final investment decision and put shovels in the ground in 2026, probably a 2 to 3 year period to build and get first production out of it. Obviously, the current copper environment is quite amenable to starting a project like this. I don't think there will be an issue of financing. And right now, like I said, they're going through a nice free cash flow mode from steady state of their current mines. And it doesn't hurt to have gold, where gold is trading right now. So it's a name I've been in and out of. I will admit I don't own it currently. But it's something, like I said, with tech, I'm looking at for the second half of this year, something probably to buy. Looking for that inflection point where the market starts to see more news about World Copper and perhaps a partner or other ways that they're going to finance this big project, as well as the positive tones from the administration that they might make this an easy one to get permitted.
Yeah, the timing will work out well for them, considering this is the beginning of Donald Trump's term. All right. We hope that helped you out. We are going to take a quick break. We're back in just a moment. Welcome back. Let's go to the phone line. Diane on the line from Goulet River in Ontario. Hi, Diane. Where's Goulet River?
Hi. My question is on Fru, and it seems like it kind of goes up, kind of goes down. It doesn't do much. And I have some, so I'd like your guest to advise, should I sell it or should I hold it? And I'll hang up and listen.
Thanks for the question. Okay, so let's pull that up. What is your take on Freehold Royalties?
Yeah, Freehold is a different beast. It obviously is a royalty company. We all know the Francos and the Wheaton Rivers and so forth. This is what I'll call a little bit, obviously a lower risk than an E&P company, like the names we've talked about. Higher yielding, I think it's just under 10% in terms of its dividend yield. What's different about it is it has chosen to be more active in the U.S. It's been involved in a lot of these Permian acquisitions of royalties. What's nice about that is the activity levels have been a little bit higher in the U.S. than Canada. I think in Q1, they were showing almost a complete reverse, or I think activity in the U.S., at least on their lands, was up 30% and down 30% on their Canadian lands. So I think about 70% of the activity on all their lands now comes out of the U.S. It's certainly where their emphasis has been on acquisitions. Maybe it's a good idea in the sense of maybe less competition. Clearly, there's a lot of competition here in Canada where people have chosen to stay Canadian-centric. I think the issue always becomes, we've had this experience a lot of times, when you go into the U.S. as a Canadian entity, sometimes you get your head handed to you, you know, because you're not ingrained with the culture. You form partnerships, you maybe hire people down there, but it's very different than being in Canada and working in Saskatchewan or Alberta or BC, where you have decades-long relationships. So we always thought there's a little bit of risk associated with that, and are they really getting access to the best deals? It's smaller than their peers, and I think there's always been a discount because of that. Even though their activity is actually not that bad, I think it's about 2/3 of what you see with, I say, Topaz, for example. But they just can't get the same level of respect as some of the other peers. And we don't have a chance to talk about Topaz, so we can talk about the differences. But it's one that we have owned periodically, but I wouldn't call it one of my core royalty names. Really, Topaz would be top of the heap in terms of what I want to own for oil and gas royalties and infrastructure. And maybe secondarily, it would be Prairie Sky on that front.
Got it. Diane, I hope that helps you out. Goulet River, by the way, north of Sault Ste. Marie, just for that. All right, let's go to Jean. Jean's calling from London, Ontario. Hi, Jean.
Hi to you both. I'd like Dennis's comments on Northern Dynasty Minerals. I'm up over 100% since I purchased it, and I'd like his comments on the future.
Okay, thank you for the question. Northern Dynasty.
That's a tough one. I don't own it, never have. It's embroiled in environmental issues. I know the EPA has never wanted to grant them permitting because of how they dispose of materials. And I think they've used even veto power. I think they've only done that 13 times in their history, the EPA. But obviously, new life under the Trump administration, because they're in Alaska. President Trump wants more materials, so this is copper gold. So all bets are off. I think the stock has almost tripled since the election. It doesn't mean I'm going to buy it. This is a $6 billion last count kind of project, massive. How you're going to finance it. It's very nice to say I could get permitting, but the other part is, well, who can I get to partner with me who can spend whatever it might be, whether it's $3 billion or $4 billion or $5 billion on a promoted basis. It's a massive project. So I still think you have that risk. But again, new life, anything can happen now that you've got an encouraging administration who want you to build this project, probably, especially in Alaska, with all the typical environment issues. And I don't know how easy it's going to be, but clearly there's been a certain layer that's been taken off in terms of a cloud over this project.
Got it. Let's go back to the phone lines. Mozz from Vancouver on the line. Hi, Mozz.
Hi, good morning. Thank you for taking my call. My question is on recent precious metals. It has had quite a run-up, and I would like your opinion as to whether it is a good entry point or should I wait for a pullback? And how does this compare to Agnico Eagle? Thank you.
Okay, thanks for the question. Wheaton Precious Metals, we have at this point trading at 126.45, a little bit up today, and climbing steadily over sort of the last year. What's your take on Wheaton?
We don't own it currently. I have to admit, whether it's Wheaton or whether it's Franco or Cisco Royalties, we don't own the royalty companies. Our preference has been to try and get the operational leverage of owning E&P companies. Clearly, the attraction to royalty companies is you don't have the commodity risk.
Sure.
You don't have the operating risk to the same degree, although it's indirect, because obviously if a mine goes down, like Franco Nevada is suffering because Cobre Panama is down. So they're not getting the royalties from this production. So it's indirect. So it's not fair to say they don't have operating risk. It's just in an indirect way. So we've preferred to own the E&Ps you mentioned, compared to Agnico Eagle. Again, best-in-class operating gold company. We prefer to have that operating leverage. If you put the charts next to each other, you'll see Agnico Eagle has outperformed Wheaton as it has for Franco Nevada. So that is our preference at this point, to enjoy the full benefit of $3,350 gold.
Got it. All right. That is all the time we have for your questions today, but don't go away. Dennis is going to share his new top picks when we come back. Time now to share some new picks from Dennis. His first one is IAMGOLD, which is a gold producer. Surprise, surprise. What do you like about IAMGOLD specifically, considering all the gold stocks seem to be up?
Yeah, I think the consistent theme across my three picks will be companies that are going to go through a re-rate, because either new projects or just a shift in business and moving towards something a little different. In the case of IAMGOLD, although it's benefited from strong gold prices, I think the real upside is going to be finally Côté, which is their mine in the Sudbury area, is going to start to operate at full speed by the end of this year. It went into production, I think, in the first quarter of last year. It was supposed to be a 3-year build, ended up being 4 years. The budget doubled. It ended up being $3 billion. You know, all sins are forgiven, because when you think of it, gold was probably $1,700 when they started building it, so it's almost doubled. So it makes up for a lot of that in terms of margins, even though the CapEx was significantly higher. They're 70% of this mine. This mine will cause them to grow from about 440,000 ounces in 23 to almost 800,000 ounces this year. So material growth. They'll deleverage. They will have significant free cash flow for possibly buybacks or distributions. I think the key here will be what happens after 2028, because their West Africa mine, which is almost the same size as Côté, ends. So I think exploration in their West African assets, as well as perhaps the next project, which is Nelligan, could be what offsets that decline in production. But in the meantime, very nice free cash flow in 26 and 27 for this company.
Got it. Okay, let's get to Spartan Delta, which is your next pick on the TSX, natural gas and liquids producer. Why do you like Spartan Delta?
This is a company where the management team since 2020 has distributed $1.8 billion to shareholders, including a $9.60 special distribution in 23 when they sold their key asset. It was Spartan at that time. Spartan Resources became Spartan Delta, the residual company. They spun out a company called Logan Energy. They went from an asset base that was kind of boring, low growth natural gas. And they kind of came out of their shell in 24 when they announced a big land package they've accumulated in the Duvernay play. Quite an exciting oil play. And so I think they'll continue to go through a re-rate as they gather scale. They certainly have the land base and the prospect list, but it's about getting scale and re-rating, especially in 26 and 27. So I see that stock having easily 20 to 30% upside, even if oil stays around $60.
Interesting. All right. Let's get to Troilus Gold, which is your last pick at this point. A small cap gold development. Tell me a bit about them.
What stands out about this one is they are going to build this mine if somebody doesn't buy them. They don't care. They have staffed up. They've had veterans of the industry join the company who have engineering and geological expertise to build mines and a track record. They right now had, I guess, 4 letters of intent for over $1.3 billion from export development companies, including Canada's. So I think they're just going through financing right now, probably in the first quarter next year. They'll put the financing in place, fully permit it. This is a project, obviously, in Quebec. This is a past-producing mine. I think probably a 300,000 ounce producer if they start building it next year, a couple of years to build out. They'll put the debt financing in place, probably a royalty stream on the silver portion of this gold mine, and then a little bit of equity maybe as a top-up. So fully financed, in my opinion, and it'll be kind of that next tier of maybe M&A, somebody who might want to buy them.
So put some money and forget about it for a while.
Correct.
Got it. Okay. We do have to leave it there. Dennis has joined us on the show. Thank you very much. Appreciate that.
Pleasure.
And thank you very much for joining us here on Market Call. We are going to show you where the markets stand at this time as we go to a break. We'll see you again tomorrow.